What's up, guys? Welcome back to the Brazil FX Trading. This is your boy Junior, and in this episode, guys, I want to be going through the top chart patterns. These are patterns that we see every day in the market, and if you're a forex trader, you need to know all these patterns on just your fingertips. Just like you know the candlesticks on your fingertips, you need to know the forex chart patterns. So these are everyday things you see in the forex market. Forex chart patterns fall under technical analysis. So I'm going to go through these one by one, guys. So make sure to subscribe if you're new around here and hit the notification bell so that you don't miss out on our cool videos, guys. So let's get started.
This video is sponsored by Trader Central. Trader Central provides funding for traders. It provides both instant funded accounts and challenge funded accounts. So if you're a trader and you're looking for a platform to trade with, you're looking to trade with big numbers, check out Trader Central right now. Sign up right now with my link in description and get 30% off your first plan, guys. Let's go, Trader Central all the way. Guys, as I told you, these are forex patterns that you need to know on your fingertips. If you don't know these forex patterns on your fingertips, it's the high time you learn them. Watch this video from the start to the end, and this forex is going to become very simple for you, because these are things that you're going to see every day in the market. So our first one is the double top. So a double top is a chart pattern where a price reaches a high, tries and falls to break higher during the second attempt. So mostly this market, we see price action, we see market coming, and it finds resistance here, then it comes down here to find support or momentum to go again, try and break this level up here. So when it comes here, it falls to break here. So this is what they mean when price reaches a high, tries and falls to break there. So it forms an M. So most of you guys, it's easy for you to identify this M, or if you don't know, it's a double top. So this is a double top. And whenever market forms like this, we only draw out a neckline where price finds its support. So we just want price to break and then reverse. So a double top is a reversal candle pattern. No, it's a reversal forex pattern. So it's just for reversal. It's either where is find it on extreme uptrends when market is going to reverse and come to the downside. So this is how it looks like. You see, we have a smooth market going up, and this is a big time frame. This is a 4-hour time frame. So we have market going in an uptrend. It falls to break this part here. It comes down here where it finds support, and you see this is a major level. Then price again goes back up again, try and break that upper part, which forms our double top, which is the M. Then when it comes here, so this is where we draw our neckline, this neckline. So we want price to break and retest, as you can see, break and retest, then market drops down big time. So this is a double top. It's a reversal forex pattern. So as you can see, this is a double top, guys. As you can see, it's a double top, and that's how it forms. So the better, when you find it on bigger time frames, you catch huge pips. And the target, we just measure out from here to the neckline. So most time this is our target. So some target we measure from here at the neckline to down here. Just measure out this, and then your stop loss, just risk your risk to has to be 1 to 2. You don't have to risk so much. So that is our double top. Our next is a double bottom. A double bottom, this is a chart pattern where price holds low 2 times and falls to break. So this is just the opposite of the double top. So this, we see price action coming down, first to break that part down there, then it comes here to find again more momentum to go down and drop, and it falls. So this time around, when it comes back, it breaks our neckline. So most times here, we just want to take trade when price comes back to our neckline and breaks it. That's all we want. And as you can see, we measure out this distance from the neckline to the last part here where market forms a top, and then so something we measure out here as our target. And top loss, we don't want to always lose so much. Our stop loss has to always be 20 pips, 10 pips. Yeah, because these are patterns that are like they're very accurate, and they will show you where market is really going. So this is our double top. As you can see, our market coming down, then it goes back, then comes again down on its second attempt to try and go down, keep on going down, but it forms a double bottom, which is a W. So most of you guys know a W. So when price comes back to this level is where we find our neckline. So we take trade after a breakout. So our third one is the heads and shoulder. So a heads and shoulder is also a reversal kind of pattern. We see here price action is a chart pattern described by 3 peaks. The outside 2 are closing height, and the middle one is the highest. As you can see, we have price action coming up here, then it forms a higher high and a high low here. Then again when it goes up, it forms a head which is the highest. Then it comes back down here, it forms this low, but the low is not lower than this, they are equal. So this is where we draw a neckline. So again when price goes, it forms another shoulder or another peak which is not higher than this middle one. So we get to see that these two are equal. So this forms the heads and shoulder. The shoulder is this one, and the head is this one. So here we take trade when price breaks this level here. That's why I want to take trade. So I'll show you here. So this is our heads and shoulder. So as I told you, half price action come in, it goes up, comes here again, forms a big head, then comes again, forms a short shoulder. So this is a heads and shoulder. So we take trade and market breaks this level, our neckline. As you can see here, we take trade here when price breaks and retests our neckline. So that's our heads and shoulders. So the opposite is just an inverse head and shoulder. And this one, the heads and shoulder, is a reversal candle pattern. I mean, it's a reversal forex pattern. So your market must have been in an uptrend, then it reverses to go to the other side, which is the downtrend. So the inverse head and shoulder, also called as the head and shoulder bottom, is a reversal chart pattern. This market must have been in a downtrend. You see, market must have been in downtrend. As you can see, we have market coming down, it forms this lower low, and then it goes back up here, try to find momentum to push down. Oh, it forms a retracement. When the second attempt, when it comes to push down, it forms a lower which is the head than this one. Again, it goes back up, it gives us this structure to show that market is going to reverse. But again, it has formed our inverse head and shoulder. This is the shoulder head. So we draw out our neckline and wait for price to break our neckline, as you can see, and then market broke the neckline with a big candle. And also you should know this, guys, always whenever you're analyzing these chart patterns, news complete structures. News all the time complete structures. So you should have that at the back of your mind. Whenever you draw a structure, a pattern, wait for news to complete it so you take a trade after the retest and all that. So that was our inverse heads and shoulder forex pattern. So the next one is a rising wedge. So as you can see, a rising wedge is a chart pattern formed by drawing two ascending trend lines, one representing highs and other one low. So here basically you find the market in an uptrend form, but it will give us a structure like a triangle, but one line representing the high and another one low. So this is how it forms. We have market coming something like an uptrend, though this is not a clear one, but I'll draw out a clear one in more videos to come. So we just need to draw out this rising wedge. This represents that market is going to come to the downside, but market just bounces up and down in our low and high trend line as we're waiting for the breakout. And most times the breakout is that news completed this structure. So this is also a reversal forex pattern, guys. It's called a rising wedge. Then the opposite is just the falling wedge. As you can see, this one market must have been coming from a downtrend, then it forms this zigzag thing. So all we have to do is just draw out this high and low trend line, one representing the low and another one representing the high. So you can see here, so this is market must have been in a downtrend like this. So you see when we draw out our falling wedge, we can see a small nice triangle. So most of the time we take trade after the breakout. As you can see, we have a big candle here. As I told you, news complete structures. We had also a doji candle down there. So news complete structures. So most of the take profits, guys, you just measure out this distance here, from here to here, or from up here to here. This is always the first move market forms to give you a target. And the good thing with this falling wedge and rising wedge, market always gives us divergence. Divergence is when on our indicator we have something opposite, and then on our market we have something also different. So as you can see, we have this slope here, and then on our indicator we have a divergence, you see, on the same level like this. So divergence means reversal, and then also a falling wedge means reversal. So this is like proper confirmation that market is going to go to the upper side. So you set your target. As you can see, market was here, so we set our target here. Then our stop loss, you don't want to risk so much, so you just risk, as you can see, where there's entry and stop, so you put your stop loss there. So that was our falling wedge. Then from there we have the bullish flag. So these are very, very, very good forex patterns that we see every day on the market. So this is a continuational pattern. So the other ones have been going through the falling wedge and all that, the head and shoulder, the down top. Those are all for reversal. Now these ones are continuational chart patterns. So as you can see, this is a bullish flag. So a bullish flag is a continuational chart pattern named due to its similarity to a flag, or a flag on a flagpole. So as you can see, this one, market must have been in like an extreme uptrend. Then it just corrects or retraces for another upward move. So market must have been in an uptrend like this and gives us this zigzag. Then after that, when we draw out our trend line, they are low and high, we just wait for market to break out. So this is how it looks like. As you can see, market must have been in something like an uptrend like this. And then we have this zigzag like this. So here what we do is just draw out this upper trend line and lower trend line as we wait for the breakout. As I told you, always market always news complete structure. So it's always news that complete these patterns. So your take profit, you just measure out to this distance from here. This push from here to here is the same distance you measure out from here to take your trade. So most guys take trades here up to there, then others decide to enter in here, but this is so risky, guys. Take trades after the breakout here to the upper side there. And most of the time, and if you want to see more of these bullish flags, check GBP, JPY, and CAD JPY trades. These recent weeks, as I'm talking right now, these recent weeks, we have had these structures form every time on the market, guys. We have had these structures form on the markets. Go check them out. Go check them out right now. Mostly those Japanese yen pairs, most of them we have seen markets form these structures. So our next one is the bearish flag. So this market must have been coming from an uptrend, then it gives us that zigzag, which represents our bearish flag. So this is how the market looks like. You see, we have market coming in a downtrend like this, then we have that zigzag, which represents the flag, and then this is the pole. So we draw out this flag and then we just wait for the breakout. As I told you guys, look here, we have a big candle. It completed the structure. I told you guys, news complete structures. Most times when we're analyzing markets, we have to make sure our technical analysis is in line with our fundamental analysis. So on our bearish flag, this height of the pole, the length of this pole from here to here is what we measure out from here to here as our target. Because most times whenever market forms this and it kind of consolidates like this, it has to form the same move, like at least before it goes the other way around. So this is our bearish flag, and this is a continuation pattern to the downside. So our next one is a bullish rectangle. These are patterns that you won't see every time, but they're also good to notice and have them on your fingerprint. So this is formed when price consolidates for a while during an uptrend. So same to this one, market must have been in an uptrend like this. It consolidates, but it forms a kind of a ranging market, support and resistance. So all you have to do is just draw out that rectangle like this and wait for the breakout. As I told you guys, news complete structures. You can see the breakout was with these big bodied bull candles. So here our target, we just measure this distance in between here. We measure from here to here. It's the same thing we measure when market breaks out here. At least market will give you that fast move. That's our bullish rectangle. Then our other one is the bearish rectangle. So it's same to this one. It's formed when price consolidates for a while during a downtrend. As you can see, market was in a downtrend. It kind of consolidates and then it goes down. So this is how this forms. Market must have been in a downtrend. Then we have this consolidation. So all we do is just draw out our rectangle and then take trade when market breaks out here. So we set our stop loss just a few pips not so far, then our target has to be here. It has to be the same level from here to here. That must be our target. So this is our bearish rectangle. So then from there we have the bullish pennant. A bullish pennant is also a continuational chart pattern. So bullish pennant, most times it appears when you have that extreme uptrend, like a steep uptrend most times. As you can see, this is that uptrend you see, then we have market consolidating, but in this way it consolidates and gives us a structure of a W. A W just means a market has to go up. So all you have to do is draw out your triangle, which is the bullish pennant, and then wait for the breakout. Guys, as I told you every time, you see a big candle broke out. So it's always news that complete structures. So here you just measure out from the first push your market side from. It's the same push you push out here to take trade. And most times, guys, find these trades on bigger time frames. Don't find these on smaller time frames. When you find them on smaller time frames, it's good, but when you find them on bigger time frames, the more pips, and you know, more pips, the more money, guys. So this is our bullish pennant. The opposite one is just the bearish pennant. You see, it's formed during a steep or almost a vertical downtrend. So here we have market coming to the downside like this. So you see market coming the downside, then you have a brief consolidation like this, then here we just draw out our triangle like this. Yeah, then here we shall see market breaking out. And as I told you guys, news complete structures. You see these red big candles, news completed structures. So same thing here, you measure out your take profit, you measure out a distance from here to here, some distance you measure out here, and then you don't have to risk so much. This has to be a 1 to 2 risk to reward, guys. We don't lose, because as I told you, these patterns are so perfect. Like they always represent what as you know that this is a bearish pennant, and market will always go there. It respects those structures. It's only some structures that we're going to see in front there that they represent both. Market may either go up or down, but these other ones I've been showing you, they all represent either continuation or reversal. So from this one we have a ascending triangle and descending triangle. So these ones are chart patterns that either represent market going to the upper side or breaking out to the downer side. So we shall start with the ascending triangle. So with the ascending triangle, when we find the market in an uptrend form and it's going up like this, it will give us this consolidation, but it consolidates like this when we're just waiting for a breakout. So it depends on where you have found this market. When you find it on an extreme uptrend, it means it shows mean continuation, but also the chances that market may reverse and come to the downside. Same to this descending triangle. Market is coming down like this, so it finds resistance. So it's this down line which acts as resistance is all equal. Like where market consolidates is equal, but this one is slanting like this. Same to this one. So this market may either go this side up or down. So I'm going to show you here an example. So this one is our ascending triangle where market is finds this resistance which is equal, then this one as our slanting. So here you can see market going up like this, which means market may either go this side up or down. Now this is our descending triangle. Yeah, as you can see, market is in a slope like this, then we have it finds resistance. So since it's the overall trend is a downtrend, so meaning we shall find resistance down. But anyway, any of those lines can act as a support and can act as a resistance. So we just set our target, and our target is always respected and will be hit. Our stop loss, we don't want to risk so much. As you can see, our stop loss is, you see our stop loss is just there. Then our target is just to measure out this distance from here to here, some distance from here to here, and always market has to respect that level and form that first move. So those are our ascending triangles. Things to note about these triangles, they either represent, they represent both. Yeah. So from here we have the symmetrical triangle. The symmetrical triangle also represents both, depending on where you find it. When you find it on an uptrend, it represents market has to continue going up. But if you find it on an uptrend and it gives you that W structure in it, it means market is going to continue and go down. But if you find it and gives you a structure like a Zig Zag, something like this, it may mean market is going to go down. Or if it forms an M pattern in the triangle, so it means market is going to go to the downside, guys. That's the symmetrical triangle. We have more charts like the cup and handle, but these are like the major ones. These are things that you're going to see every time, guys. The symmetrical triangle, which represents both Then the ascending triangles also represent both either market to go to the upper side or the downside. Then this is the bearish pennant, which represents continuation to the downside. Then this is the bullish pennant, which represents market to continue going to the upper side. Then from there we have the bullish rectangle, the bearish rectangle, which represents continuation to the downside. Then we have the bullish rectangle, which represents market to continue going up. From there we have the bearish flag, which also that's continuation, the bullish flag continuation. Then these are reversal. This is the falling wedge, which represents reversal to the upper side, but this one we love to use it with divergence. After this video, I'm going to make a video about divergence strategy, how we use divergence to catch big moves in the market. Then from there we have the rising wedge, which represents the reversal to the downside. Then we have the inverse head and shoulder, which is a reversal chart pattern. Then the heads and shoulder, which is also a reversal pattern, a chart pattern, which represents market to go to the downside. Then you have the double bottom, which represents reversal to the upper side, which you call the W. Then from there we have the double top, which represents market to come to the downside. This is also a reversal chart pattern. So guys, I'll give you some notes to note here. Whenever you're using these chart patterns, note this: when you find these on bigger time frames, you're going to catch 100 pips in the market, 200 pips in the market. You know, when you're just risking just something like 50 pips and you're targeting something like 900 pips, 500 pips, this is where you find them. Look for these chart patterns on 4-hour time frames, daily time frames. These are the best time frames to find these chart patterns. And the other thing, take notice that it's always news that completes structures. I can even give you another example here. You see, news always complete structure. We have a big red candle that represented, okay, market has to break out, but with high pressure, you see. So that's my last point. Remember, news complete structures. So whenever you draw out this structure, you know that, okay, news is going to break it out. That's like 90% always the time news complete this structure. So, and also guys, keep these structures on the tips of your fingers, because you know, when you're forex trader, this is really like a big part about technical analysis. You need to know all these on your fingertips, guys. So if you enjoyed this video if you watched this video from the start to the end, guys, make sure to subscribe. Don't forget to turn on your notification bell, because we're going to be bringing more and more content to help you guys learn forex. So I hope you all enjoy this video. I'll see you in my next video, guys. See you.